this is one of those moments where I can easily imagine mood improving, particularly if we were to see a decline in gas prices. But I could also see the wheels fall off, that people have had enough, and that what we're seeing in college campuses is more of a coming attraction of social unrest that is, again, very reminiscent of the 1960s.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. In markets, as in life, sentiment drives decision making. And until sentiment shifts, the status quo will maintain, even when at extreme conditions. Today's guest has made the study of sentiment his life's work, which is particularly timely given that consumer confidence continues to plunge, with the recent April consumer confidence numbers coming in far below the consensus estimate. Now, this is important because when it comes to the markets, as well as a number of other issues central to our way of life, we may be walking dangerously close to a tipping point, where the prevailing sentiment suddenly reverses and the herd bolts in an unexpected direction, potentially leading to sharp changes that most will be caught unawares by. So, what do we need to be keeping our eyes on most closely? To find out, we're fortunate to speak today with behavioral economist Peter Atwater, adjunct professor at William & Mary College and author of the book The Confidence Map, Charting a Path from Chaos to Clarity. We'll ask him what his key confidence indicators are telling him about the prospects for the rest of 2024. Peter, thanks so much for joining us today.
It's great to be here, Adam.
Thanks, Peter. Well, it's always great to have you on the program. I think this is your first appearance on the new Thoughtful Money channel, so welcome.
I'm delighted, and congratulations.
Oh, thank you. No, you're so kind, and thrilled that you're here. I love talking with you, Peter. One, just because you're such a smart, well-spoken educator, but also, as we've talked about in the past, I'm a huge fan of the study of behavioral economics. We think that people would make incredibly rational decisions around things like money, because it's so quantifiable, and yet we oftentimes make incredibly irrational decisions because we're driven by our emotions, like by sentiment, because we are human animals. We are creatures that have an evolutionary wiring that oftentimes isn't optimized for the world of economics and finance. So I want to dig into your latest observations on the whole behavioral economics side of things. If we can, though, let's just start with the general question I like to kick these conversations off with. What's your current assessment of the global economy and financial markets?
So much sentiment today is conjoined. So if I look at the mood of bondholders, it's largely mirrored in the mood of equity holders, particularly small cap equity holders. And so it's mirrored in currencies. And so what I am focused on is if we see a break to the upside in equities, it's likely to be paired with a drop in rates and a weaker dollar. And if we think about that combination of lower rates and a weaker dollar, then it's, Katie bar the door to how high markets could go from here. Because you have this tailwind of currency translation and lower borrowing costs that benefit corporate America in a huge way, particularly leveraged corporate America. On the other hand, if this was just the top, then we have this potential where you have a dollar wrecking ball paired with higher interest rates, paired with falling markets. And so I think that whichever direction is next, the potential is big in either way. And I know that feels like being a two-handed economist or a three-handed economist, but this is one of those moments where I can easily imagine mood improving, particularly if we were to see a decline in gas prices. but I could also see the wheels fall off, that people have had enough, and that what we're seeing in college campuses is more of a coming attraction of social unrest that is, again, very reminiscent of the 1960s. And this is where that turbulence up and down, this churning that I sense in the markets and in the economy, feels very much like an echo that we've been here before, socially, politically, economically, and this is just our term in this very heavily gyrating, highly impulsive, highly emotional market.
Okay, can't wait to dive into this with you. I'm just going to pull up the headlines that you were mentioning there earlier, just to show the tremendous swing in sentiment. So this was a couple weeks ago. You said it would have been great if you'd come on then, because you would have been waving your, it looks like we're at a top.
Yep.
Here's the curse of the economist, right? They put
Yeah.
the balloons on there. And then, as you said, after this, the S&P dropped a little over 5%. And then we had headlines like this one.
Yep.
You know, how far can America's stock market fall, right?
Yeah.
So,
So the
really,
media is doing its job following mood, particularly the economist.
okay. So, you know, you're saying, okay, you're sort of seeing this whipsawing back and forth, but as it translates into the markets, yes, the S&P did just fall 5%. It's rebounded pretty heftily since. It's still sort of in this compressed, or I think you used the word coiling range here, right? So you see this sort of like a tug of war where the rope isn't moving very much at the moment, but at some point one side's going to win out, and then the the momentum's all going to go in that direction. What was interesting is you mentioned the term, you know, Katie bar the door if we move to the upside here. It also sounds like it's going to be Katie bar the door in whichever direction it moves, right? It's going to be either, hey, this is we're going to have a melt up here, or it's going to be a pretty ugly correction, right? You're not expecting too much in the middle given your confidence indicators, right?
No, the status quo is unsustainable. There's too much tension to me in the rope, and one side is going to exhaust, and with that, the rope will move very quickly.
Okay. And I don't want to be in danger of unnecessarily conflating different factors here, like economic indicators, market prices, and social mood in society in general. But I'd like to kind of talk about all of these with you, and you can kind of help me parse through them all. Okay, so from a economic standpoint, so you know, I'm trying to figure out, you know, what's something that's going to get sentiment really rollicking to the upside about the economic data. And if I look at the economic data, it's not terrible necessarily across the board. In fact, you can still, you know, people are still making the no landing narrative or soft landing narrative. But, you know, GDP growth in Q1 came in at only 1.6%, right? That's disappointing, and certainly shows an economy that's beginning to slide down. More importantly, though, and I'm working on this piece I hope to get out this week, and I'm still hoping I'm going to be able to, but it's about the fact that it is increasingly looking that interest rates are going to be, you know, how Powell used to talk about higher for longer, now looking like they're going to be high for even longer, right? Which is, hey, it looks like the dream of rate cuts in 2024 is practically close to dead at this point. There's even chittering now that it still may be higher for even longer, right? That we might even get a rate hike out of this, right? And not willing to stick my neck out there just yet. But it looks like, you know, high interest rates are going to linger for a lot longer than the market was expecting coming into this year. And at some point, you got to think that high cost of debt, whether it goes higher or just hangs out where it is right now, just acts as this corrosive, you know, acid, if you will, on the economy, but also just on sentiment. It's hard to gain optimism when you're just increasingly getting pulled down by this heavy weight. What do you think economically could be a sentiment boost?
Yeah, so I think that we have had or are having capitulation as it relates to high rates. So there is agreement now. In fact, there was a Wall Street Journal article this week that talks about the end of the low rate era, or the low rate interest rate environment is over.
Yeah.
So nobody is expecting us to go back. And that's one of those signs that says to me, maybe we could. Nobody believed that. If nobody believes it, then it's very likely.
Then the odds are, yeah, exactly.
Yeah, it's the contrarian nature of group behavior. And so nobody could imagine today, 4%, let alone 3% rates. If you want to get laughed off the stage, just suggest that. So I think we need to be more open to that possibility. And here, if we think about the perception of low interest rates, the perception of interest rates and inflation expectations overall is heavily influenced by our sense of gas prices. That if you reach into the consumer's mind, the single variable that impacts inflation expectations more than any other is what's happening at the pump. And so in the last couple of weeks, we've seen prices rise at the pump. I think gas prices are up 12 cents in the month of April, which is a large increase relative to the base. And so I think you've got some concern on the part of consumers that inflation is rearing its head again. And volatile inflation is as bad as upward inflation in the minds of a consumer. They're both generating feelings of uncertainty.
Yeah.
So what could help the consumer? If we see gas prices fall and inflation expectations fall, interest rates start to fall. And remember that the consumer is paying a record high level on credit card debt today. I'm not sure, you can punish the consumer much more, at least the low-end consumer, on the rate front, given just the absolute levels of interest rates on credit cards today.
And just to let folks know, I think the average APR on a credit card today is 25%.
I was going to say between 27 and 28. So you're
okay. Yeah.
But yes, we're talking about a number that feels unconnected to interest rates, where they are in the market.
Right. Well, and also too, it feels kind of unserviceable, right?
Yeah.
You're giving a person at the lower end of the spectrum. Of course, lower end of the spectrum, I gave you the average APR, so they have higher ones, right?
Yeah.
You're giving them basically a penalty fee that they're probably never going to be able to actually meet.
No, but where higher interest rates are causing pain beyond the credit card front is in the auto lending front and in the small business front. So small businesses that were used to paying 6 or 7% are now paying 11 to 13%.
Right.
If I'm a small business owner, that's a kick in the teeth. So at the same time, if we look at the Magnificent Seven and a lot of the biggest corporations, like the wealthy overall, they're net beneficiaries of higher interest rates. If I'm a non-borrower, this benefit that I reap from interest rates going from 0 to 5% is enormous. So I think what we have with this environment of rising interest rates is, again, this K-shaped penalty, where those at the bottom are paying a whopping price, while those at the top are benefiting enormously.
Well, they are, and also, other factors we can toss in there is stocks have done great over the past year and a half. Asset prices have done great over the past year and a half. Bonds a little different, but still. So basically, those who have owned assets, right, whether bonds, short-term, whether bonds that are paying you a nice tasty coupon now, right? Whether it's stocks, whether it's real estate, which amazingly, maybe we can get into this at some point in the conversation, has defied the traditional mathematical seesaw logic between higher rates and home prices, right? So if you've had assets, you've done great. As you've said, it's that lower half of the K that's just getting increasingly crushed as the timeline goes on here. And look, I don't know where gas prices are going to go from here, but right now they're not headed in the right direction. I know the market is different than the economy, but I have a hard time personally looking across the economic landscape and seeing like, oh, this is what's going to get everybody really jazzed on at least the U.S. economy right now. And the U.S. economy has been the dirtiest shirt in the laundry basket, whatever, the best looking horse in the glue factory. I just interviewed Dr. Art Laffer yesterday. He said it's the tallest midget. So everybody has their own analogy for it. And so we've been kind of getting by on the fact that we're not doing as bad as everybody else, and maybe the rest of the world starts to pick up. I've definitely heard some arguments recently be made that China's now starting to stimulate its economy again, and that will maybe goose a little bit of economic growth elsewhere, although it might also contribute to inflation too. So we'll find that out. But I don't see. I personally am just having trouble seeing the economic stimulant in the near term that gets everybody saying, "Oh yeah, growth's getting back in the right direction." Now the market's obviously very different, and I guess my question there is you mentioned that kind of correlations, like in 2022, correlations went to 1 pretty much. Like just about every asset went in the same direction, and that year it was all down. Now you're seeing that correlations are becoming that tightly coupled again, and if the animal spirits somehow get released again, everything will go up together again. Again, we don't know which way it's going to break, like you said, but just put on your bull hat for a moment. What are some of the things you think could happen in the next month or two to break the tug of war and let the bulls win?
So I think you could hear something from Powell. I think you could see.
And I'm sorry, but what would it be from Powell? Would it be, I'm going to do rate cuts anyways?
That in the if they're seeing a slowdown in things that concern them, they'll trade growth for inflation.
Mm-hmm.
We haven't seen that yet, but that possibility exists. And this is where the feedback from small business owners is so critical. And I'm going to be watching the small business report, sentiment reports quite closely, because I think they're going to give us clues as to how much pain has really been incurred by those at the bottom.
Mm-hmm.
But I think that we also have this whole question of technology benefits.
Okay.
And nobody, we have all of this, spending in AI, but we haven't started to see benefits spread out. And so one of the potential boosts to the market could be evidence of productivity gains coming from AI.
Okay, so it could be like earnings reports where companies are saying, hey, we blew through our profit estimates because AI has been so awesome for us.
Yeah. And so those are narratives that begin to soften the impact of interest rates to say, hey, we can grow even with these higher rates. So you end up with a 1994 kind of scenario where, okay, things have improved, rates have gone up, and now we have some accelerant.
Okay, that makes sense. Let me, if I can, just sort of put you on the spot here and just ask you your gut feel about what what the AI, what's going to happen with AI sentiment as we go through the rest of this year, because AI sentiment was a huge part of the market's gain in 2023. It still is here in 2024, and no doubt there's been a ton of spending on AI, right? So, the difference between companies like NVIDIA with a lot of the dot-com high flyers was that, there's real revenues and real profits in NVIDIA's case versus a lot of the just purely story stocks back in the dot-com era. But that sentiment, that raging sentiment hasn't been pierced yet in any real material way. A lot of people have begun speculating, hey, is this going to be like the internet where, yes, it will be very transformative over time, but it may take the better part of a decade or more for us to really begin to realize the full potential of this. And have we just gotten so exuberant that we pulled way too much of tomorrow's value into today? And that there's going to be some disappointment here in the near term as people begin to realize that AI didn't transform my business literally overnight.
Yeah, so the AI boom has been interesting to me in contrast to what we saw, for example, in the EV space. This whole experience with AI has been bets on thoroughbred horses that have been at the track for a long time. These are, the biggest of the big is where we're putting our wagers. What we haven't seen in AI is the madness. The idea that you and I can create a company that just has AI in its name and raise, $1 billion. That, where's the Nikola? Where's the Lordstown Motors of AI? We haven't had that yet. And so that possibility exists. And to the extent it does, we should expect valuations and maniacal behavior that accompanies it. The flip side of it, though, Adam, is that the bubble in AI is more restrained than we saw in the bubble in SPACs and NFTs and EVs. And that what we've just witnessed, I would consider from a sentiment perspective to be a lower high. And that lower high then opens up the possibility of a major drop ahead. Because there was no madness in this. I mean, step away from NVIDIA and micro strategies and a half a dozen names. It's all pretty tempered.
I totally get the point, and that's a very important point of these people have been betting on Secretariat versus the 100-to-1 odd horse nobody's ever heard of. So it didn't get stupid.
The unborn foals. I mean, we were betting on horses that hadn't even been born yet.
Yeah, which obviously opens the door to the question of, do we need to see that before the AI mania is played out? Meaning, for those who think it has gotten crazy, that it could get a lot crazier. So I totally hear what you're saying. Now, that said, those few veteran thoroughbreds make up a tremendous amount of market cap. And the AI promise has dramatically increased their market cap, as well as the market cap of the entire market, right? It's really driven the indices. So I guess you could say, even if it didn't get outrageously speculative like we've seen before, even if it got sort of moderately so, a moderate correction in them would still have really big impact for markets. And oftentimes, in many people who haven't really even been following AI, because these stocks are so over-owned and so many ETFs around the Wall Street landscape that you could basically, and I'm just making this up, not a prediction, but you could see your portfolio value on average go down 20-30% or so and wonder why. And it's just because there was a 20 or 30% cool off in the AI craze.
Yeah, and I agree with you. I mean, NVIDIA could be this cycle's RCA. There's nothing that says we have to go through that mania again. And to your point, we have embedded in all of these indices a concentration that was a resurrection to the markets when they went up, but could do immense damage on the way down. And I don't think folks, to your point, in the world of passive investing, truly appreciate what they own.
All right, so I want to dig into that point with you, and I want to pull up some recent quotes of yours. You said the reversal in sentiment, especially when it gets really speculative, can be wild. And what goes up like a rocket frequently descends like one lacking a parachute. And I'm not necessarily saying you think that's exactly what's going to happen with the AI landscape, because you mentioned it's been more measured than we've seen in previous places. But when you talk about this this tug of war that's going on and this coiling, and you're not sure which way it's going to break, it sounds like you do think that when one side does win that ton of war, not only will the movement be largely big, but I'm intimating, and correct me if I'm wrong, that you think it's going to be relatively rapid too?
Yes, absolutely. You could use cocoa as an example, where you have this, prolonged coil, and then boom, you have this asymmetric move to the upside.
And when you say cocoa, just to make sure folks are following, you're talking literally about the commodity, correct?
The commodity. Yeah. And there, it's useful because you can see this rocket-like trajectory. And then in the last 72 hours, we've seen almost a 40% decline. So one of the things we fail to appreciate with bubbles is that the unwind is always most extreme at the beginning. What to me distinguishes pullbacks from bubble bursts is the trajectory of the initial decline. Because if this is a bubble, it's a very quick descent out of the gates, and one that no one is prepared for.
All right. While you were talking, Peter, I just went and searched for cocoa prices. So we're seeing here a bit of what you're talking about, which is just a couple of days ago, cocoa prices hit a high of what, over $12,000 per ton, I guess. And that's now come down already to about 9,000 in just a couple of days. So that's what, like a 30-some-odd correction, 30% correction or so.
Yeah. Yep.
In just a week and a half.
Exactly. And actually, it's even shorter than that. It's in just a couple of days.
Wow. Okay. All right. And so yes. So to your point is when things hit an extreme, imagine the rubber band that you stretch, you overstretch. When the snapback occurs, it's the early phase of the snap that tends to move the fastest, the most violently. So I want to tie that with something else you said, which is psychologically, it's one thing to give up gains. It's another thing altogether to incur losses. And I want to talk about that a bit, because this is something I mentioned a fair amount. The research is really clear on this. And I think it was done by Daniel Kahneman, if I'm not mistaken, in your field, which is that empirically, they've determined that investors feel the pain of a loss twice as much, more or less, as they experience the joy of a gain, right? But we as investors, we don't keep that in mind, right? So when we're getting all excited about making money and whatnot, we tend to kind of forget that if we ever really knew it. And we tend to oftentimes overextend ourselves and make ourselves vulnerable to losses, because we're getting all caught up in the speculative fervor, not keeping in mind that, hey, these gains are great, but man, if this thing ever does reverse in the way that you say a lot of speculative extremes do, we're going to feel so much more worse if we end up eating losses than we're enjoying the gains right now.
Yeah, and what we forget is that with investments, the higher the price goes, the more we want it. So you end up in this scenario where demand is greatest at the highest price, which means that the crowd's cost basis is very high to begin with. It's not like the crowd bought Apple at $2 a share. The crowd, rushed in to buy NVIDIA, near its peak. And so what happens is as the price starts to come down, all gains get destroyed right off the bat. And what you're then left with is this pain that comes as people start to lose money. And those losses, to your point, feel bad. Scarcity hurts more than abundance rewards. So the risk in this is that as prices begin to drop and drop precipitously, those gains go away and people now have lost money. And this is something we saw in 2007 with housing. We saw it in 2000 with .com stocks. We saw it in 2021 with Bitcoin. So we have to be really cognizant of the psychological impact of that pain. And I would also add, Adam, if this is the end of the bubble, this will be the third bubble burst in 25 years. And that repetition matters.
So let me ask you about that. And real quick, I just wanted to put up the actual graph of what we're talking about that came out of the research that went into this study. And folks, you can go online and type in loss aversion theory, or sometimes also called prospect theory. But this isn't just an opinion. There's actually been real quantitative research that's gone into this. Sorry, what was the last thing you just mentioned there, Peter?
This is the third bubble. This
Third
will
bubble.
be the third bubble burst.
Yeah.
And potentially the fourth one if we look at 2021 as being one as well.
Okay. That's actually a great point. Let's put an asterisk next to that one and say, well, nobody could have seen the global pandemic coming, but still, the system was vulnerable to some shock like that, given how overvalued a lot of assets have gotten. But let's just even call it three. Historically, when there has been an asset price bubble, it oftentimes has been a defining moment for the generations that lived through it. And they always say that generals fight the last battle, right? Like that's become the demon that they then, spent the rest of their lives trying to keep at bay. And a great example of this is the Great Depression, right? Folks who lived through the Great Depression, we all heard the stories about, they were incredibly frugal and cost conscious. You'd hear stories about grandparents who passed away and then their heirs go up in the attic and find, tins of flour and stored food and things like that, right? Because these were just the habits they developed during the Great Depression. What has changed in the national psyche this time around where we're just not learning our lesson, right? We let an asset bubble grow in the .com era. We then let one grow in the housing bubble era. And then in what many have called the everything bubble era, we've put those previous two bubbles to shame. And those are all, within living memory and largely in the past 25 years or so. Why, for some reason, are we breaking with our behavior in the past and not fearing asset price bubbles the way that previous generations had once they burst?
I think there are a couple of reasons. One is if you look at the monetary policy that has accompanied these different bubble bursts, it has benefited the leveraged.
Mhm.
It has rewarded the risk taker over the saver. And so at every turn, those that had capital, while they lost some, earned so much more on the way out that they're rewarded to keep coming back.
Okay. So sorry to interrupt, but just so I'm following, is it a combination of I'm getting enriched so that the juice is worth the squeeze, right? That like, yeah,
Yeah.
there's going to be some pain in it, but I'm going to make so much more than the pain it's worth doing, plus a moral hazard of, hey, yeah, it might get bad, but they're going to come rescue me.
Yeah. And again, I'm not sure there is an investor out there who does not believe that markets always go up. It's the truth behind passive investing. It's the truth behind all of our retirement savings strategies, that you can't time the market, and that at the end of the day, time is your friend, and ultimately they go up, and today they go up faster than ever before. So
Mm-hmm.
now you're really stupid to try to time the markets. The other piece of it, though, Adam, is the visibility of extraordinary wealth today.
Mm-hmm.
And that these icons of extraordinary wealth, with all of their trappings, is unavoidable. And so it's very difficult to not be jealous and envious and be drawn into risk taking when you're seeing others not only make money, but make money at a level that is outrageous.
Yeah. Gargantuan, I would say unprecedented, but maybe the Vanderbilts and the
Yeah.
Rockefellers, were similar, but there were seemed to have been a lot fewer of them in the past than there are in the present, right?
Yeah.
So all right, so now we're really treading into what I really wanted to dig into here with you, which is again sort of the sustainability of that, and where sentiment comes into play on a social level, right? So uh, those very wealthy people, and not even the Elon Musks of the world, but let's just say the top 1%, even the top 10%, right? They drive a disproportionate amount of spending and investment in the economy, right? These are the people who are, I think the top 10%, maybe it's 20%, is responsible for 40% of all consumer spending, right? These are also the people that invest in companies, and they create jobs and opportunity that employ the rest of everybody. Um, uh, but as those people suck up more and more and more of the spoils of the total pie, you have a greater and greater percentage of the population that gets left behind. And we've certainly gone through an accelerant in the past 4 years where a good chunk of folks who were in the middle class are now not, right? Their cost of living's gone up, their wages haven't gone up commensurately. And more and more, greater and greater percent of Americans are losing faith that they're going to be able to have live the American dream, right? And I think the modest American dream, like a middle class lifestyle. In fact, there's a stat recently that a year ago, 27% of renters said, "I don't think I'm ever going to be able to afford a house." Right? This year, it's 40%. Right? That's the delta, right? Um, so obviously, and as you said, all the policies that we've been enacting for the past several decades at least reward those who are already at the top. And even though they give a lot of lip service to how they're doing it to help the bottom 80%, the bottom 80% just seems to get worse and worse off as this goes along. So it's hard for me not to look at that and have strong concerns just about the social sustainability of this, that at some point people say, look, I don't care if these guys are the ones that are driving the economy. They're basically turning this country into a feudal system where there's a small, rich aristocracy and the rest of us are just debt serfs to be mined, basically. How worried are you about that?
Terribly worried. I don't think that what divides us is as much left and right as it is up and down.
Mm-hmm. Well,
And
define what you mean by up and down, but I'm guessing you're talking about
economically,
socioeconomically.
yeah, in terms of wealth. And I think sometimes Republicans and Democrats are in opposition to each other so vociferously so that people don't pay attention to this up and down divide. If we just keep focusing people on the troubles between the left and the right, they'll ignore the economic reality.
Forgive me for injecting on this, but I hear this a lot in the comments, to a lot of these videos, which is, hey, this is all the part of the plan, and they're just trying to divide us and keep us distracted and arguing amongst ourselves. Do you actually give some credibility to that?
No. I think
okay.
that is just the nature of our politics. No,
okay.
I
Maybe similar outcome, but it's not a grand design.
No, I think those that suggest that attribute a far greater skill to our political class than I think is deserved. But someone could quite easily come along who unites those at the bottom with an economic narrative. And we forget in these moments that it is ultimately the scarcity that matters to us that unites us, that brings people together who might otherwise not be united. If I don't have money, if I don't have job security, if I don't have whatever it is, I will forgo my political identity and join arms with you because we are fighting a common opponent. If you look at picket lines, you'll find that they're filled with both the left and the right. So we need to better appreciate that out of these feelings of vulnerability can easily form a wave that is driven by economics, not by ideology.
All right, and I agree. I feel to a large extent when somebody walks into the voting booth and they pull the curtain, generally what drives their vote is how they feel about their own personal economic situation, right? It goes back to the Bill Clinton, it's the economy, stupid, right? And I think if you're feeling okay, then you have this higher order luxury, you could almost say, of voting, because of all these other grand policy ideas that you have. But if you feel miserable about your economic conditions, I think you're pretty much going to vote for the person that you think is going to make you better off economically. It's almost sort of like a single issue once you drop below the content line on your own personal financial situation. You can disagree with me with that. I'm curious to hear if you do.
I would just broaden it, Adam, to the vulnerability that matters to you most.
Okay.
So
you mean security might be one, like if there's a lot of crime in my neighborhood.
It could be security. It could be feeling vulnerable because of immigration. It could be feeling vulnerable because of education or the lack of representation, lack of voice. We can't get inside people's minds in that moment, but ultimately what matters to you as you're making that choice is where you feel most vulnerable in what matters.
Okay. I think that I totally agree with that. I think right now, what matters most to people, where they feel most vulnerable, is the economy. And I'm going to bring up a chart just to validate that. And I'm going somewhere with this. here's the chart. Most important issues for voters in the United States as of in February, which is the most recent data they had for this. You'll see inflation and high prices are at the top here, right? Not a huge shocker. The reason why I'm bringing this up is I think it is likely to be a very big voting, maybe the biggest voting issue come this November. I think the current administration has its work cut out for it because people aren't that happy right now. And they're running out of time, right? Time is ticking. If we get that boost to the upside, maybe it'll provide some relief. I don't know. It might, or it might make the general downtrodden populace just look at the rich getting even richer and say, "Damn it," right? So that'll, So curious to hear your thoughts about this, but I guess where I'm going with this is, obviously, one of the dangers of this is that we tip into either an eat the rich type of social rebellion, right? Where we do say, look, let's get rid of our left-right differences and let's just all go after those bastards at the top, right? And while I think a lot of the anger may be well-deserved, I'm not sure that it would end constructively. I don't know, be curious to see. But also based on previous conversations you and I have had, you've issued some warnings that have really stuck with me, which is that it's when the populace kind of gets to this point of this desperation and frustration is oftentimes when the biggest firebrands can be elected or we rally around them because they speak to our cause. As you said, they give voice to the pain these people are feeling. And that itself doesn't always have a good outcome. And what you said that's really continues to echo in my mind is if you stand out in the cold rain long enough, you'll get in the car with anyone, right? And of course, this explains to a certain extent the rise of figures like Hitler in the past, right? Where you had a German populace that was just broken and just feeling shamed and frustrated and everything by the terms of World War I. And suddenly a guy came along who, gave them a banner to rally behind that said, hey, you deserve better and you're the victim of all these guys and I'm going to get you what you deserve. And, somebody very bad was thrust into power then. So I'll take a beat here, but I am concerned that this could be the vector that really drives political change going forward, and it could be positive, constructive change, but it seems like there's an awful lot of potential too that this could kind of go off the rails. So what are your thoughts?
Yeah, so if I look at the political narratives today, they're all heavily skewed towards grievance. And you can almost see political figures, left and right, trying out, what grievance resonates most, and then using that to solidify and create cohesion among their followership. And so you'll see, again, left and right, this focus on, let me remind you of why you feel bad and the pain that you're feeling. And here's what I'm going to do about it. And I think that the challenge on the political side is, to your point, the time between now and November is very short. And so the shouting has to become especially loud. And the potential grievances have to become even more extreme in order to hold attention. And this is, as I think about the reasonableness of narratives between now and November, I'm quite concerned that we're going to, that out of necessity to compete for airtime, what is being spouted borders on hysterical stories and narratives that are ungrounded in reality, but that resonate with the crowd.
All right, which kind of whips us up to our more base nature, I think, as a populace, right? We're being driven by limbic system, instincts in that type of environment. I'm curious, and again, this is completely nonpartisan discussion, but it may be as an example of what you're talking about. There was a trial balloon floated just a couple of days ago by the Biden administration about raising capital gains up to 44%. Could that be an example of one of those where it's maybe not necessarily the plan, but they're just trying to say, hey, does this get kind of the dispossessed feeling like we're going after those rich bastards?
Yeah, although I think that hurting my enemy isn't nearly as effective as benefiting me at their expense.
Mm-hmm.
And so, on that specific issue, I'm not surprised that it hasn't gained much traction. I think that folks are suspicious that at the end of the day, either party would do anything to harm the rich. So the question is, what are the two parties going to do to come to the aid of those at the bottom? And can they deliver that message authentically?
So I know you're an economist and not a political analyst, but how much of this is theater in the sense that, let's be real. It's this wealthy cohort that basically is funding and lobbying DC and has largely captured our political system. So, they're not necessarily, their self-interest isn't served by policies that come out that are wealth redistributive and punitive to the wealthy. And my presumption is, yeah, maybe some of these things will get passed, like, hey, yeah, we're going to increase either income taxes on the wealthy or capital gains or whatever, but there are going to be all sorts of carve-outs and whatnot that actually allow the wealthy to sidestep it, and they're either toothless or they're tax increases that goes to everybody, and it's the lower populace again that gets left holding the bag when all is said and done.
Yeah, and this is where I think both parties are tone deaf to the potential of a grassroots initiative that coalesces those at the bottom in a way that feels far more authentic, and that is that the crowd believes will deliver what it's seeking in terms of benefits to those at the bottom versus those at the top.
Okay.
May not
Well,
be
all
in
right.
time for November, but I don't think we're at a point yet where either party should feel a sense of victory.
Okay. Well, last question around this, which is like, how crazy do you expect it to get between now and November?
I expect that both parties, given again, unless mood starts to rise dramatically, both parties will be offering a unlimited buffet of messaging that is oriented around feelings of powerlessness, uncertainty, vulnerability, grievance, that create a sense of dread, and therefore a need to vote one side or the other.
Or the other. Okay. So how big of a deal was sending stimulus directly to households? Like how big of how important of a precedent was that? I've talked to enough people on this program that I think the consensus of experts I've talked to is a big deal, and it's part of the toolbox going forward now. Anytime there's going to be a big, economic crisis, it's not just going to be what's the Fed going to do, it's going to be what's the fiscal side going to be. But that toolbox can be easily pulled out of just the realm of economics into the political world, where again, I'm not making a partisan case here, but if you're in the sitting administration and you're going into a tight election, why not come up with some reason, a month before to rationalize why we're sending some, checks out to households, and it almost becomes like a, vote for me, I'll give you money, right?
Right, a vote buying exercise.
Yeah.
I think that there's a dilemma that we folks aren't focused on. It is one thing to give that level of income stimulus, that income support, when interest rates are near zero. It's a very different experiment to try that when interest rates are at 5.5%.
Right. And inflation is elevated. Yeah.
And inflation is elevated. And so I think the higher rates go, the less public policy has that toolbox. And I think that the other piece of it is temporary support does not do very much for the psyche, because we know that it's not forever. And therefore, when it comes to confidence, we live in the future. And so we're immediately moving past that benefit to what happens when it stops. And so, as much as it may be a tool to use to prevent calamity, I think policymakers are misguided if they think it's going to offer an enormous boost that has legs.
All right. So as a political investment, you don't think it's a good one, because folks are basically going to discount what you gave them, and it's all about what they think you're going to give them. Let me ask you this.
Exactly.
Sorry, yeah.
Yep.
All right. From a policy standpoint, was that a mistake? In other words, did we open a Pandora's box now, where whenever times get tight nationally, the populace is going to demand direct stimulus because you did it in the past?
Yeah, I think the populace will demand it. Do I think it was a bad choice? Not for those at the very bottom. But one of the challenges with the way we did it was we painted with too broad a brush. And we inevitably do that in a crisis.
Right.
So there are plenty of folks who benefited from it who should not have. But that's what happens when you're making economic policy at 2:00 in the morning over a weekend.
Right. Yeah. No, PPP and otherwise, I know a lot of people who would say we may be painted with too big of a fire hose.
Yes. Yeah.
But, okay. All right. Well, look, I guess in starting to wrap up here, so given your particular lens, which I find fascinating to look through, like the whole thing about sentiment and what drives us, what drives our decision making, you see potential for a big move, either up or down, and I believe that's sort of a near-term call, right? So I guess before I get to my big question, one intermediate question, which is, when you look at the rest of this year and perhaps 2025, are you net optimistic or concerned about our national economic prospects?
I'm concerned by the condition that exists, irrespective of where the market goes. Because wealth is so concentrated today, it will benefit a few. But if it goes down, it punishes far more. The problem that has arisen with shareholder primacy is that management believes that it is its responsibility to benefit when things go well and to punish the employee when things go poorly.
Mm-hmm.
And so we have to find a way, particularly with wealth as concentrated as it is, that if the market declines, corporations do not go back to their playbook and eviscerate the workforce in trying to sustain earnings for a limited part of the population.
I don't know if we have a playbook for that yet. I just don't see anything other differently, at least in the near term. If the economy turns down, then a corporation's just saying, "Well, I got to survive. I got to lay people off." What sort of reform would you be thinking?
Yeah, I think that we have to recognize as businesses that business more and more forms this social fabric, and that for businesses to routinely turn to government where the taxpayer is footing a bill that could otherwise be footed by the corporation on a short-term basis, I think there's a broader discussion that has to be had. You know, I was sitting in a presentation today. Someone was talking about the history of the Hershey Company, and during the 1930s, Milton Hershey created what is now Hershey Park, the beginning of this attraction. Why? To keep people employed. And I think that there's a lesson in that businesses, rather than slashing in these downturns, need to be thoughtful about their communities. And this is one of the things that the global corporation has lost sight of. That if you're Milton Hershey running a company where everybody who works for you is, with an eye shot, you behave differently,
right,
than when you're moving corporate headquarters. I'm stunned. Oracle is now moving its corporate headquarters for a third time in a few years. It's like, where is a sense of place? Mobility is one of those things that is most beneficial to those at the top, and those at the bottom cannot afford to go.
Well, and this also sounds similar to Henry Ford, basically saying, look, we've got to pay our employees a wage that actually lets them over time afford our product.
Yeah.
Right. It's a way of it's kind of an ecosystem approach, right? And so how do we keep the ecosystem sustainable? And it's a much longer discussion, but I think globalization really allowed these companies not to have to really care so much about their local ecosystem, because they were able to leverage all these benefits of other parts of the world that offered tax shelter or cheaper labor or whatever, right? Okay, so the question I'm trying to work myself up to is given all this landscape that you see, what advice do you have for investors who are trying to navigate what's coming, and whether it's ways to make themselves less vulnerable, maybe to job loss here or whatever as the economy slows, or volatility in the markets, or social change, or whatever. So I'd love to hear your thoughts on that. But I'd had a question I was working, you really made me think about with this, which is, okay, so you think that corporations need to have a greater appreciation for the role of their employees in the whole process. But, we've had a tremendous incentive, I would call it a malincentive, for corporate America for a long time to try to employ as few humans going forward as it can. The cost of an employee has been going up dramatically for a long time, and it's now going through another spike, with the wage inflation that's going on right now. But we've had, outsourcing, we've had automation, we've had software and robotics, but now we obviously have AI, right? So the AI might, I have a hard time thinking that it's not going to unleash a big corporate downsizing. because you're just going to need a lot less people to do the work that the AI is going to do. And so isn't that a big headwind into trying to get corporations to care more about their total? They might care more about the employees they end up retaining, but they may, they may go through a pretty massive downside. And I've mentioned this a lot of times, like Elon Musk at X, forget about AI and everything. He just showed corporate America, at least the big tech side, hey, you very well may not need nearly as many employees as you think, because we got rid of 75% of ours and we're still here.
Yeah, I think that experiment remains to be seen.
Sure. But there were a lot of people that were saying at the time,
yeah.
oh, this is it. Twitter's dead. It's not going to be
No.
around in 6 months, right?
But I would say I think we're likely to go through a backlash to AI between now and then. Inevitably, when new technology is introduced, there is a backlash period.
Good.
I mean, we forget about the computer phobia of the mid 1980s, but we will have a era of AI phobia.
Will it would sort of be the modern picket lines where it's like, don't work for this company because don't support this company because they're anti-employee because they're going big AI?
No, I think it will be fear of companies using AI to begin with.
Okay.
That folks will uncover its malevolent side, that they're ignoring today, and some of that is employment, but there's inevitably there's a downside to all of this that needs to be exposed first.
Okay. Beyond the Skynet downside that it may kill us all at some point in time.
Yeah. Yep.
Okay. All right. Well, to my big closing question here, as you look through your unique sentiment lens at all these trends that we've talked about, for the issues that you're concerned about, and maybe perhaps some of the opportunities you see, what is your general advice to regular investors like those watching this channel for things that they can do or think about doing in their lives to either be less at risk or maybe take more advantage of some of these trends?
Yeah, so the first thing I encourage people to do is to plan for what you can imagine. All of our investment decisions, Adam, are driven by our imagination of the future. And so you need to have an imagination for what's ahead, good or bad.
Okay. And I would imagine you would combine that with like just invest in becoming informed and staying informed so that you can imagine more clearly what the future is actually likely to be.
Yeah, but I would even say if you imagine something dark, if you imagine something light, that's going to drive your behavior.
Mm-hmm.
And I'm not going to be able to change that. And this is where the second piece becomes so important, which is you also need to be prepared for what you can't imagine.
Okay.
So if you are driven today by pessimism, make sure that there are elements of your portfolio that prepare you should better times result. Conversely, if you are incredibly optimistic today, make sure you are prepared for a potential downtime. And thinking in those terms allows you to be clear on what you can imagine and how you're positioned for that, which then helps you to see, okay, what am I not prepared for?
Mm-hmm.
What are the gaps? Because ideally, the future is uncertain, always has been, always will be. Those that are most successful are those who plan and move forward with what they can imagine, but who also are very well prepared for the things that they can't imagine happening.
Okay. All right. I'm big fan of both those answers, and the second one really validates something that we say an awful lot on this channel, which is that folks should whether they're a DIY investor or whether they're working with a professional financial advisor, really focus on baking risk management into your portfolio. Have your primary thesis, but then have part of your portfolio saying, position to say, hey, look, if I'm totally wrong, if it just for whatever reason goes against what I'm sure is going to happen, I'm not going to be 100% vulnerable to that. I've got some insurance in place.
Yeah, I'm a believer that what creates diversification in a portfolio isn't a bunch of slices of a pie, but owning things that are laughable as well as things that are a sure bet. That mixing the sentiment of what you own will help you navigate this environment of uncertainty.
All right, fantastic. All right, well, look, Peter, as we start to wrap up here, very important question for people who very much enjoyed this conversation. Perhaps maybe it's their first time hearing from you, and they'd like to go follow you and your work. Where should they go?
So they can find me at peteratwater.com. They can follow me on Twitter at Peter_Atwater. I also write things on LinkedIn for my blog. And ultimately, Adam, if they're interested in how I look at the world, I would encourage them to pick up a copy of my book, The Confidence Map, at the library, at Amazon, because I think it helps people better understand why these feelings of uncertainty and powerlessness matter so much today.
Okay. Peter, when I edit this, I'll put up links to those resources. I'll also put up a big picture of your book. I believe you are at work on a companion to that book as well. Is that correct?
Yeah, I'm going to spend the summer working on a workbook. There are a lot of questions that people have asked, and I want to provide a way for individuals to better understand how do these factors impact their own lives. What often our feelings of certainty and control are driven by prior experience. And so being able to understand how do those experiences in our work life and our personal life drive the choices we make today.
Okay, great. All right. Well, Peter, I've got one last question for you. It's about what's a big lesson that a successful fellow like yourself, who had a lot of success on Wall Street, now actually is a professor and teaching younger generations. What's a big life lesson or career lesson you've learned along the way that you think is important to share with this audience? As you think about your answer for that, I'm just going to do a quick 30 seconds of housekeeping. Folks, if you've enjoyed this conversation with Peter and would very much like to have him come back on again in the future, especially once he's perhaps maybe finished that workbook and has the ability to share some of the frameworks in it with us, please let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And I won't give my usual spiel about the wisdom of working with a good professional financial advisor, because I think Peter and I just pretty much for the large part covered that. But if you want to set up a free consultation with one of the financial advisors endorsed by Thoughtful Money, just go to thoughtfulmoney.com. There at that website, you can schedule those free consultations. You can get our free newsletter. And of course, you can stay up to date on all of our latest content. All right, Peter, we're back at you for this final answer. What is a big life or career lesson that you've learned that you think is worth sharing with the audience?
So it may be a function of my age and the end of the semester rapidly approaching. I think we live in a time, particularly thanks to social media, where everyone wants to be remembered. And being remembered means you have to do something, often for yourself or with others, but it's focused on accomplishment. And I encourage people to think of it this way: rather than living a life to be remembered, live a life to be missed. Because to be missed is about connection. It's about bringing something to others that they value and that when you're gone lingers. And to me, I'd rather be missed than remembered. It's just, there's such a huge difference, and we forget that, particularly today.
We do, and this is something I wrestle with a lot. There's a Maya Angelou saying that I think is similar in sentiment, which it says, I'm paraphrasing, People don't remember what you said, they don't remember what you did, but they remember how you made them feel, right? And when I think of my children, they are going to totally remember my wife much more fondly than they're going to remember me, just because I've been, so committed to work, and obviously I love my children, and I've been as much in their life as I possibly could be. But my wife's just great at the little things that just make you feel great, and I tend to just be much more functional about what I'm doing with them. But I totally agree. And people on this channel have heard me say it a lot. When they talk to people who live to be over 100 and they ask them what matters, the number one thing they always say is relationships. They don't say money, they don't say accomplishments, they don't say trappings of wealth or even experiences. It's people. And oftentimes it's not the famous people they knew, it's just the people who were closest to them and how those relationships enrich their life. And of course, that's all about remembering people in a way that you're going to miss them when they're gone. Yeah. All right, Peter. Well, look, thanks so much. It's always such a joy interviewing you. Good luck on writing the workbook. And when it's done, really look forward to having you back on this channel again.
Thank you so much, Adam.
Total pleasure, Peter. Everybody else, thanks so much for watching.